Well, there's been a lot of talk lately about silver finally breaking the cycle, because it jumped when a lot of people thought it should have stayed stuck. So, in this video, we're going to separate the real signal from the excitement, and you're going to walk away with a much clearer idea of whether this is just another fast silver bounce or the beginning of something bigger. Today is Friday, May 1st, New York time, so comment below what day and date you're watching from, because in a market like this, even a few sessions can change the whole picture. And if you value this kind of work, support the channel by subscribing and commenting John AG Best below. That lets me know you want more direct market breakdowns without the noise. Now, the first thing we have to understand is that silver did not rise in a vacuum. It moved while gold was still firm, while oil was still hot, while the dollar was soft, while the Fed was divided, and while the economy was sending mixed signals. That is a strange cocktail, and when silver moves in a strange cocktail, people get emotional fast. Some people immediately say, this is it, the big one. Other people say, no, it is just traders chasing a bounce after a sell-off. And honestly, both sides can make a decent argument. So let's take it apart. Silver had been beaten down enough that a bounce was almost invited. When a market falls hard for a few sessions, it does not always need a perfect bullish story to recover. Sometimes it just needs sellers to run out of energy. Then bargain hunters show up, short-term traders cover, and suddenly the same metal that looked weak yesterday looks powerful today. But this time there is more going on. From recent market updates, silver was still trading near the mid-70s area while gold was hovering around the mid-4,600s. That means silver is not just crawling back from weakness, it is trying to hold a very high altitude after a rough patch. And that is important because high price areas behave differently. At lower prices, buyers feel like they are getting value. At higher prices, buyers need conviction. They need a reason to believe the move still has fuel. So when silver holds up after a big rally, the question changes. It is not, can silver bounce? The question is, can silver stay bid? That brings us to the dollar. When the dollar weakens, precious metals usually get breathing room. Not always and not perfectly, but enough that traders pay attention. A softer dollar makes metals cheaper for foreign buyers, and it also signals that confidence may be shifting away from cash at the margin. But here is the trap. Dollar weakness can explain some of the move. It cannot explain all of it. If this were only about the dollar, gold and silver would probably move in a cleaner, more proportional way. But silver outperformed, and when silver outperforms, you have to look at the ratio. The gold to silver ratio is basically a scoreboard. It tells you how many ounces of silver it takes to buy 1 ounce of gold. When that ratio narrows, silver is gaining strength relative to gold. That does not guarantee a moonshot. But it does tell you silver is not just following gold around like a shadow. It is pushing for leadership. And that is where this gets interesting. Because silver often frustrates people for a long time before it moves. It lags, it chops, it fakes out. It makes investors question their entire thesis. Then, when the crowd stops paying attention, it can suddenly run faster than almost anything else in the metals space. That is silver's personality. Not smooth, not polite, not easy. Now there is also the oil problem. Oil above the triple-digit zone is not just an energy story. It bleeds into inflation expectations, consumer confidence, shipping costs, corporate margins, and central bank pressure. The latest energy outlook has been pointing to elevated crude prices in the second quarter before a possible cooling later, and recent market reports have tied high oil directly to renewed inflation concerns. So why would silver rally if oil is raising inflation fears and potentially keeping rates higher? That is the part people miss. Higher rates can pressure metals because metals do not pay interest. But higher inflation uncertainty can support metals because people look for protection outside paper promises. So oil can be both a headwind and a tailwind at the same time. Sounds contradictory, but markets do this all the time. The same data point can hurt one part of the thesis and strengthen another. Now let's bring in the Fed. The central bank left rates unchanged, but the statement was not exactly calm underneath the surface. Officials acknowledged elevated inflation, energy pressure, and uncertainty connected to the Middle East. They also held the target range steady, while several officials disagreed with the policy action or the wording around future easing. That matters. Markets can deal with a hawkish Fed. Markets can deal with a dovish Fed. What markets struggle with is a Fed that looks split in the middle of an inflation shock, because then every new data release becomes a fight. If inflation stays hot, the hawks gain power. If growth weakens, the doves gain power. If both happen together, then the market has a real problem, because the Fed has to choose which fire to fight first. And that kind of uncertainty is exactly where precious metals start getting attention again. But silver is not just a monetary metal. This is where the story separates from gold. Silver has industrial demand tied to solar panels, electronics, vehicles, grid upgrades, electrical contacts, medical uses, and the broader push toward electrification. You do not need to hype that into something ridiculous. We do not need to pretend every new data center is secretly a silver mine in reverse. But we also cannot ignore that silver sits inside many of the systems the world is trying to build. According to the latest publicly available industry outlook, the silver market was expected to remain in deficit, with industrial demand still doing a lot of the heavy lifting and solar demand remaining a major part of the discussion. That is the long-term support. But here is the counterpoint. Industrial demand can be bullish, but record high prices can also destroy some demand. If silver gets too expensive too fast, manufacturers adjust. They thrift. They substitute where possible. They delay purchases. So the industrial story is real, but it is not magic. That is why price matters. A bullish metal can still get ahead of itself. Now we need to talk about the futures market, because most of the drama you see on screen does not come from someone buying a few coins at a local shop. It comes from futures, options, margin, open interest, hedging, and fast money moving in and out. That does not mean the move is fake. It means the move can be amplified. CME describes silver futures and options as tools for price discovery and risk management, and its volatility tools track forward-looking expectations from options. Translation: this market is not just about metal, it is also about positioning. When volatility rises, traders change behavior. When margins shift, leverage changes. When leverage changes, prices can move faster than fundamentals alone would suggest. So if silver jumps hard in one day, you have to ask, how much of this is real demand? How much is short covering? How much is futures positioning? And how much is investors finally waking up? The answer is probably a mix, and that mix is exactly why silver can feel explosive. Now, some people will jump straight to COMEX stress and say this move is because the exchange is about to break. I would be careful with that. Yes, warehouse data matters. Yes, registered inventory matters. Yes, delivery behavior matters. But no, every rally is not proof of an immediate default. That is too simple. A delivery notice is not always metal leaving the vault. A futures contract is not always a person demanding bars tomorrow morning. And a tight market does not have to collapse to reprice higher. In fact, the best outcome for investors is not a broken market. It is a functioning market that slowly admits silver was mispriced. If the market breaks, price discovery gets ugly, liquidity disappears, rules change. Everyone thinks they will get the perfect exit, but in a broken market, exits are exactly what become difficult. So do not root for chaos. Root for repricing. Now, the economic data adds another layer. The economy grew at around a 2% annual pace in the first quarter, after a much weaker pace in the prior quarter. That sounds decent. But the details were mixed, with imports weighing on the calculation and growth coming from several different areas rather than one clean, booming engine. At the same time, jobless claims fell sharply to just under 200,000, with the moving average also easing. That tells you the labor market was not falling apart in that moment. So traders were handed two messages. Growth is not dead, but inflation is not beaten either. That is not a simple setup, and silver does not like simple setups anyway. This is why the rally is not only about one headline, it is about the collision of several forces at the same time. Dollar weakness, oil strength, Fed division, mixed growth, firm labor, industrial demand, futures positioning, ratio compression, and after all that, investor psychology, because psychology is the hidden driver. At the beginning of uncertainty, people often want cash, they want safety, they want the cleanest, most liquid thing they can hold. But if uncertainty lasts long enough, cash starts looking less safe, especially if inflation is eating purchasing power. Then investors start looking around. Gold gets attention first, then silver starts whispering. And when silver starts whispering loud enough, traders remember how violent it can be. Now, does this mean silver goes straight up from here? No, that is the mistake. Silver can be in a long-term bullish structure and still slap late buyers in the face. It can rally hard, pull back harder, and then continue higher after everyone gets exhausted. This is a metal that loves to test conviction. So the technical levels matter, not because charts are perfect, but because they show where the crowd is likely to react. The mid-70s area is the first battlefield. If silver can hold around there and push higher, bulls gain confidence. If it slips back toward the low 70s and cannot recover, then traders will say the breakout attempt failed again. Above that, the next major resistance zone is where previous momentum stalled. Below that, the low 70s and the round number beneath it become important because that is where confidence starts to crack. Gold matters too. If gold stays firm, silver has cover. If gold rolls over sharply, silver may struggle to lead by itself. And platinum and palladium are worth watching because strength across the precious metals complex can change sentiment. When multiple metals start moving together, traders begin to think in terms of a broader reset rather than one isolated spike. But do not overstate that either. Platinum and palladium have their own supply chains, their own demand base, and their own risks. They can help the mood, but they do not guarantee silver's next leg. One more thing, the physical market and the screen price do not always speak at the same speed. A futures rally can happen in minutes, but mine supply, recycling flows, fabrication demand, and investor coin demand adjust much more slowly. That lag can create confusion. People see the price jump and assume physical demand exploded that same day. Maybe it helped, but often the first move is paper positioning, and the physical market confirms or rejects it later through premiums, delivery behavior, and availability. That is why I would watch the follow-through more than the headline. If dealers stay tight, if industrial buyers keep stepping in, if funds keep adding exposure, and if the dollar keeps losing its grip, then this move starts looking deeper. But if premiums cool, futures volume fades, and silver cannot hold the levels it just fought to regain, then we have to admit the market got excited before the foundation was ready. That is not bearish, that is disciplined. And discipline is how you survive silver in this cycle. So putting it all together, what is really happening? In my opinion, silver is trying to prove that the old pattern is weakening. The old pattern was simple. Fear rises, people run to cash or gold, silver lags, then maybe later it catches up. This time, silver is trying to move earlier. That is the signal, not the one-day gain, not the social media excitement. The signal is the timing. If silver starts leading during uncertainty, that is a different character than investors are used to seeing. But it still needs confirmation. We need to see stronger closes. We need to see dips get bought. We need to see the ratio keep improving. We need to see the dollar stay weak enough to give metals room. And we need to see whether futures traders keep pressing the move, or whether they disappear the moment volatility turns against them. If you're successful, share your success story in the comments so others can stay motivated. And tell me this in the comments too. Do you think silver is finally leading, or is this just another emotional bounce before the next shakeout? Because I think that question is the whole market right now. The bullish case is clear. Silver has monetary appeal, industrial demand, supply tightness, inflation protection, and momentum. The bearish case is also clear. High rates can pressure non-yielding assets, high prices can cool physical demand, and speculative rallies can reverse fast. Both can be true. That is why this market is so dangerous and so interesting. So yes, silver may have broken part of the cycle, but the real test is not whether it can surge. We already know silver can surge. The real test is whether it can hold strength when the headlines cool off, when the dollar bounces, when the Fed talks tough, and when traders start taking profit. That is where breakouts become trends, or fail. For now, silver has earned attention. Now it has to earn trust. And as always, this is only my market read for education and discussion. It is not financial advice, it is not a buy or sell command, and it definitely should not replace your own research. Silver can move fast, so respect the risk before you respect the hype.